Hi, and welcome to this week's market presentation. Latest news. Peace talks between the US and Iran had been progressing throughout the past week, with the US presenting a 14-point peace memorandum to Iran, sparking a major market rally. Iran's counterproposal sent to the US later in the week was rejected by President Trump over the weekend, with the president deeming the proposal as, quote, unacceptable. The diplomatic stalemate now leaves the path to de-escalation very unclear, with the prospect of renewed military action by the US against Iran. The impact on energy markets was one of extreme volatility, particularly when it came to crude oil prices. Brent crude prices, for example, swung from over $115 a barrel to below $97 a barrel before rebounding to the triple-digit figures once again. Markets continue to price in a higher risk of a prolonged Hormuz blockade, with transit through the Strait of Hormuz continued to be effectively blocked. The impact is most notably felt in the oil market and for refined products, given the disruption to roughly 20% of global oil supplies. The impact on global gas markets is smaller, affecting just 3% of global supply, but still, given the tight nature of global gas markets, particularly as it relates to the LNG market, this remains the very significant supply shock to gas markets as well. The crisis is expected to delay the previously anticipated LNG oversupply that markets had begun pricing in to start in 2028 and beyond. Most important has been the damage to Qatar's LNG export capacity. The US is ramping up fuel exports to record levels to offset shortages, but limited LNG export capacity is reducing the potential upside to global supplies. Weather. The latest weather forecasts are showing slightly cooler weather throughout this week across most of Europe, with temperatures as much as 4 degrees below the seasonal average. Through the weekend and early next week, we'll start to see some milder temperatures more in line with historical norms. Precipitation is expected to pick up across much of Europe over the next 7 to 10 days, although looking at the Nordics in particular, the weather outlook remains drier over the coming weeks. Average wind speeds are also expected to pick up at the beginning of this week in particular, adding a boost to wind power generation outlooks. Crude oil and LPG. Crude oil market saw a lot of volatility, as just mentioned, over the past week. Overall, prices decreased week over week, but are once again on the rise starting this week, following the rejection of President Trump of Iran's counterproposal. Overall, crude oil markets continue to price in an end to the war coming soon and a resumption of crude oil flows through the Strait of Hormuz this year. Nonetheless, as we continue to see the supply disruption impact the physical flow of oil, we're certainly seeing significant increases in the price of refined products, particularly looking at gasoline, diesel, and jet fuel. Natural gas. Natural gas prices over the past week, again, showing quite a bit of volatility. So overall weekly decreases week over week. For the front quarter for TTF, we saw prices down almost 4%, with the frontier down almost 3% on the week. Nonetheless, the diminishing prospects of an end to the war following the halt of negotiations, certainly adding more bullish pressure in the market starting this week. Total supply saw further decreases over the past week as we continue to see LNG imports be disrupted due to the war in Iran, but also as Norwegian gas flows into Europe decreased over the past week in the midst of the Norwegian gas infrastructure maintenance period. Fortunately, total demand has similarly eased down over the last few weeks on the back of favorable weather conditions, pushing total demand to the lowest levels in over 5 years. The impact of total demand and supply has meant that injections into storage have continued over the past week, although that level has eased off over the past week due to the decrease in supply in particular. Overall injections so far this injection season have remained more or less in line with the average since 2012. That has allowed storage levels to continue increasing, now just around 35% full, still noticeably below the average since 2012 and below last year's levels. As we see the continuation of the supply disruptions from the Middle East, and once we see an uptick in consumption during the summer, we could see injections diminish during that period of time, adding more pressure on storage levels ahead of the upcoming winter. Looking at the gas supply mix, we highlight the decrease in Norwegian gas flows due to the ongoing maintenance period and the continued decrease in LNG sendouts as LNG importing to Europe continue to decrease. Asian markets continue to outbid European markets for LNG, with Asian prices still at a premium to those of Europe. One factor alleviating the price competition for LNG globally has been the reduction of imports from China, as China has much more aggressively undergone gas to coal switching as a result of the war in Iran. Investment fund positions saw a slight uptick in long positions as the market reassesses the prospect of an end to the war in Iran and what that will mean for the supply outlook for Europe. Overall, market participants in terms of investment fund positions remain more bullish on the market. Coal. Coal markets saw a decrease over the past week, in line with decreases that we've seen in both crude oil and natural gas. The decrease there very much on the back of expectations of a positive outcome to those peace negotiations between the US and Iran. Starting this week, we're once again seeing more upward pressure on the market as those negotiations have stalled. Overall, we continue to see ample global supplies of coal, and for the European market in particularly, the limited further potential for gas to coal switching, limiting the prospect of increasing demand for coal. Over in Asia, however, we are continuing to see significant increases in coal consumption out of China as the country moves towards gas to coal switching, adding support to Asian coal prices in particular. EU and UK emission allowances. Carbon allowances saw an upward movement over the past week, with European spot prices up 4%, December 26 product up nearly 2%. Leaks of the free allocation measures indicated no notable changes to the current framework, removing some of the bearish uncertainty that was priced into the market, contributing to the slight uptick in prices. Adding to the upward movement in the market has also been the increase in emissions from the power sector over the past week on the back of a drop in renewable power generation, as we can see here, with power sector emissions going from a 5-year low to now in line with the past 5-year average. Investment fund positions for Europe have remained a little more steady over the past week, still in net long territory, but very much cautious of potential policy changes as pressure to alleviate the impact of higher carbon prices on industry manufacturing continue to be discussed at the European level. On the UK side of things, the ongoing discussions to link the EU and UK carbon markets, keeping positions from investment funds on the long side of things. Electricity. Moving towards electricity markets, German power prices saw limited movement over the past week, easing slightly with that decrease over the past week in natural gas prices, compensated to some degree by the uptick in carbon prices. Overall, we still see contango in the market between Q3 and Q4 of 2026. Overall, the frontier saw a decrease of around 1.5 percentage points on the week. The price evolution was rather similar across most of the other European markets, with decreases over the past week. One exception has been the Nordic region, which is seeing power prices continue to face bullish pressure from the dry weather outlook for the region, worsening the outlook for hydro storage balances there. Looking towards total demand and residual load, we note a slight decrease in total grid demand over the last couple of weeks, in line with the past 5-year average, while residual load saw an uptick over the past week, driven again by that drop in renewable power generation we mentioned earlier. Looking at the European supply mix, we note that decrease in French nuclear power generation, a trend that we've been seeing since the start of the year, but in line with the evolution over the previous years and still above the output over the past 5 years. Renewable power generation saw a decrease over the last few weeks, going from a record high level to now output in line with what we saw in 2024 and 2025. The decrease in renewable power generation has come at the expense of an uptick in fossil fuel power generation. Taking a closer look at renewable power output, we see the biggest culprits in the decrease in total output coming from both wind and solar power generation. For wind, output has now fallen below the past 5-year average due to lower wind speeds, while solar power generation, while seeing decreases over the past week, remain at a record high for this time of year. Lastly, hydro reservoir generation saw an uptick over the past week, moving from 5-year lows to now closer in line with the past 5-year average. Although again, the outlook for hydro reservoir generation remains poor across Europe, given the drier weather outlooks that we see in the latest forecasts. For fossil fuels, the biggest uptick was seen in gas generation, with a sharp uptick over the past week, going from 5-year lows to now output in line with the past 5-year average. We've also seen a slightly more support for hard coal power generation as well, although as mentioned earlier, the limited potential for further gas to coal switching, certainly limiting the upward potential for coal-fired power generation. And lastly, looking at the guarantees of origin, we see a further upward trend in the price of GOs across Europe, moving up to now a 2-year high, as prices have been increasing roughly 120% for 2026 production year, with other years upwards of around 80 to 60% increases over the past month as well. When it comes to guarantees of origin, the main sources of the bullishness are the deteriorating outlook, particularly for hydropower output this year, given the drier weather outlook, and the slower growth in wind power generation output as well, in terms of year-over-year growth. That is tightening the supply outlook, while on the demand side of things, expectations remain bullish there, with the growth of data centers and AI-related loads expected to increase demand for renewable electricity obligations. That covers this week's market presentation. Thank you for joining.